Hey everybody, welcome back to the Economic Analyst channel. In this video, I'm going to go over some recent developments that have been going on inside of our markets, particularly in government treasury. So the yield curve has inverted as many statisticians, financial analysts, and economists define the yield curve as the 10-year treasury minus the 2-year treasury. And inversion means that short-term interest rates on the 2-year treasury yield are now trading at a higher rate than the 10-year treasury, and they briefly inverted in the beginning of April of this month. It only lasted for a few days, and now the yield curve is slightly positive, but this spooked investors as this may be an ominous warning that the economy is going into recession. When we look at other times that the yield curve has inverted in the past, it seems to be a harbinger or a warning that the economy is going into recession. Now, no one really knows why this phenomena tends to occur inside the United States, but as I've alluded to further, this is a symptom of not investors possessing magic knowledge and buying the 10-year treasuries, buying up, then gobbling up those bonds, driving the rates below the 2-year treasury. This is usually a case of the 2-year treasury rising above the 10-year treasury because the 2-year treasury is dictated a lot by Federal Reserve monetary policy. In this case, private holders of 2-year treasury bonds are dumping their government bonds because they know that the Fed is about to raise the federal funds rate and is going to continue lifting that rate. So they're running ahead of the Fed by dumping those bonds, which has temporarily inverted the yield curve. In the meantime, the Fed has nearly panicked from this. As released from their minutes of the Fed meeting in March, Federal Reserve officials are now talking about possibly selling off assets held by the Fed totaling $95 billion a month. Now, for a frame of reference, this would be a double the pace of an asset sell-off that the Fed did do under Jerome Powell's guidance from 2017 to 2018, where at that time the Fed was selling about $40 to $50 billion in government bonds per month. They're now more than doubling that pace, possibly to $95 billion. The composition of the sell-off is $60 billion in treasuries and $35 billion in mortgage-backed securities, which more or less resembles the makeup of the holdings of securities at the Fed right now. While the Fed owns $8.8 trillion in assets purchased off the market, $5.8 trillion of it is government debt. Most of the rest of that $3 trillion remainder is mortgage-backed securities there. So the Fed is thinking about accelerating the pace of the sell-off of their assets, and some of the participants at the Federal Reserve were talking about doing a 0.5 point hike in March, and that may be coming through the pipeline in the next coming months, which would accelerate the rate of Fed quantitative tightening than I anticipated here. As I've mentioned before, and I made a video a couple of videos ago, I said that this was too little too late, and the reason why is because price inflation is here to stay. In this chart right here, I've created a price formulation chart that's here in blue and overlaid it against the consumer price index in orange. The price formulation is easy to calculate. I took a modified version of Irving Fisher's quantity theory of money. I took the money supply and divided it by calculated quantity goods traded to create a price formulation index and index that against the consumer price index. And you can see here that money basically moves along with prices when you adjust for the volume of goods created in the economy pretty closely. Now, there are cases where it has diverged. For example, in the 1990s, price inflation actually ran ahead of my price formulation using the money supply. But in the 2010s, the money supply price formulation ran ahead of the CPI. But now, ever since COVID and the large injections of money being created by the Fed, purchasing nearly $5 trillion of government assets and mortgage-backed securities off the market, the money supply has exploded, and it will yield high inflation for years to come. To put a damper on it, the divergence between the price formulation chart that I created and the CPI was about 20 to 25%, meaning that the price formulation chart was about 25% higher than the consumer price index. And yet now we're seeing that divergence increase to 60%. So what does that mean? It means literally that prices would have to increase to about 20 to 25% just to get back up to the equilibrium point that the prices of the measured in the consumer price index had, according to my price formulation chart, before we went into the COVID pandemic, the government shutdowns, and that steep recession. Now, if we do see a reconsolidation between the two lines, then prices won't increase by 20 to 30%. Prices will actually increase by about 30 to 40%. And that would be a massive increase in inflation over years. It does not mean that we would see 20 or 30 or 40% inflation in 1 year. This would more than likely spell out, but this would definitely indicate that we would be seeing double-digit inflation for years to come. Now, while the money supply growth rate has dropped ever since June of 2021, and this is coming after the Fed, massively increased purchases of government securities and mortgage-backed securities off the market, and there were emergency loans that were granted out by banks and stimulus spending from the government. A lot of this has waned, but the money supply, as measured by M2, is still growing at 10% plus per year. And now this has made this divergence between my price formulation chart and the CPI reach all-time levels, and there will be some type of reconsolidation. Unless if we get some kind of increase, huge increase in volume of goods created through higher GDP numbers, which will not happen without higher inflation, we will see higher prices consolidate these two lines together as we see a reconvergence down the line in the years to come. When we take a look at the analysis, and I've created videos on this before, we've seen that, over time, using the 60-year trend, the price formulation and the CPI run very closely together. The divergence is really only 0.5% apart. And even when we use the adjusted CPI numbers, where I have gone back and taken the old CPI formulation that was used prior to the changes made in 1982 and 1990, which reflected changes in housing calculations and hedonic adjustments, and ran that and extrapolated that to today. It's not perfect, but based off of that extrapolation, the difference is still the same. We still see a strong correlation between my price formulation calculation and the CPI, with an average error rate of 0.5% per year over time. And when we take a look at the trend line, this 0.5% really just manifests in the last 10 years. It's unknown whether we're seeing a permanent divergence between the money supply and the CPI, but my guess is that there was extraordinary circumstances that kept the CPI levels from elevating at the money supply levels, namely cheap oil prices more than anything else. And now that those cheap oil prices have gone away and higher oil prices are here to stay, we will probably see the money supply the consumer price index catch up to the money supply. Now, the Fed's motives to start increasing the sell-off of their assets, if they do engage in selling off $95 billion a month, I have went ahead and started putting that into my bank reserve calculations on how that's going to affect the bank reserves at the banks. Factoring in that government debt will increase by a whopping $2.2 trillion this year, which is the fiscal deficit from the federal government plus the interest paid on government debt, which will amount to about $600 billion this year. Factoring those 2 points in, we will be running into significant problems in the beginning of 2024 in terms of bank reserves being drained. Now, while there's still this buffer here of Fed repos being sold out to banks because of excess liquidity, this will more than likely dry up very quickly in the coming months, as the selling of assets will dry up the necessary selling of the Fed repo markets, because, quite frankly, bank reserves will start to drain, which will decrease demand to buy these repurchase agreements from the Fed, which is just temporary Treasury selling on to the banking market here. Now, factoring in an increase in the savings per year, which is just an increase from the increase in the money supply, we're still looking at running into severe problems in bank reserves in 2024. Now, there are a couple of things that could, cause the banking system to stabilize and not meet this doom and gloom scenario that I'm talking about. The big one is if the deficit on the government were shrunk. If the government deficits were shrunk, especially from lower government spending, this will reduce the strain that government debt it will have on the banking system and may save the economy from imminent recession. Instead, we would just have to worry about how the higher interest rates will have on the credit markets. But based off of what I'm seeing now, the Fed's speeding up the selling of assets combined with net government debt hitting the banks and sucking out all that liquidity, in less than 2 years, we will be going through a banking crisis that will force the Fed to reverse policies here. Now, when we factor all of this in, what does all this mean? Well, essentially, as the Fed engages in their tighter monetary policy, this will put a strain and on the banks, but in the plus side, it should cause the money supply numbers to drop, as banks will be more hesitant to lend money. The government has also decided to restrain some of its spending, even though government debt has already increased by $700 billion in just 1 quarter. This should calm down in the remaining parts of the year, as basically the Fed is sucking out that excess liquidity. Now, it's unknown whether the Fed's policies here is actually selling bonds back to the banks or just allowing these bonds to roll off of their balance sheets, because I do not know the rate at which the Fed repurchases debt off the market through increasing the money supply. My guess is that based off the money supply growth rates from 2017 to 2019, even though we saw a drop in the growth rates, the growth rate of the money supply was still positive. So that tells me that the Fed wasn't really sucking out money out of the market, as it was just allowing the debt that it purchased to roll off the balance sheet. And instead of repurchasing that debt with printed pieces of paper, calling them dollars, and shelling them to the banks, resulting in an increase in the money supply, they just didn't print the pieces of paper and buy the new debt off the bank's balance sheets. If we see something similar to that happen again, then we should see the money supply start dropping down to a 4 or 5% annual per year, and that will eventually calm down inflation rates. But as I've alluded to before, that calming down in the inflation rates will take some time to manifest, for we still have this huge lag in prices that the consumer price index will have to catch up to. So my guess is that we will see double-digit inflation for the next couple of years, or we will see a strong increase in GDP caused by some type of boom in the economy, one or the other. It's unlikely that this divergence will remain, though it is a possibility that some of this will remain as we see a new stable equilibrium. So in other words, prices might adjust by another 10% this year and then basically run in line with the money supply with a new wider divergence. What might be the cause for this? Well, there could be lots of factors, but essentially the role that the U.S. dollar plays internationally and the demand for dollars internationally for international transactions, for oil, and for other types of multinational agreements between countries, that might cause an artificial demand in the dollar. So even though we have this higher money supply, it does not necessarily result in higher prices. I do think that that was one of the factors, along with low oil prices, that's what kept the CPI lower and not rising to substantially higher inflation, as some economists were predicting based off the money supply growth rates. If we start seeing that trend manifest again, then yeah, we might see some elevated inflation, but it may not reach those apocalyptic proportions that I alluded to earlier in the video. In either case, though, with what the Fed's antics and policies that they are openly debating, this shows that the Fed is really panicking about the current economic situation that's going on. They're really worried about inflation, and also I believe they're worried about this negative yield curve. For, in my opinion, when they saw that this yield curve went negative, I think when these minutes were released, even though this took place in the middle of March, this may have caused the Fed to really contemplate actually speeding up their asset sell-off. And the reason why is because I think that what they would want to do is to put upward pressure on these longer-term interest rates in order to keep this yield curve positive. So it's no secret that the assets that are held by the Federal Reserve, most of these are long-term government treasury securities. They're not expiring. They're being held on the Fed for multiple years, and so the Fed selling this would push up that 10-year treasury theoretically, and although the federal funds rate hikes might price up the 2-year treasuries, I'll bet more than anything else that what they're gambling is that by taking such a staunch hawkish approach to selling off long-term treasuries, that long-term interest rates will climb faster than short-term interest rates, keeping the yield curve positive. The Fed is obsessed with quantitative statistics here, as most people are, because this is human nature. I myself am very similar to it, though I recognize the limitations that statistics and quantitative metrics can have in emulating and telling the story about what's going on in the economy. In either case, though, if the trend between price formulation and the money supply holds true, as it has in the past, or even to some degree of truth, then we are definitely looking at double-digit inflation for the next few years before we see it calm down finally from the Fed's tighter monetary policy. And guys, that's all that I have for this video today. If you like the content that I produce, make sure that you show me some support. Like this channel, subscribe to it if you haven't already. Drop me a comment and let me know what you think below. I love the discussion that has been going on. I've been reading all of the comments. I'll start commenting a little bit more on some of the questions that have been asked. And stay tuned next week, because next week what comes out is the price indices for both the consumer price index and the producer price index. That's really going to tell the story more than anything else. But as I start noticing other data points and trends that are going on, I'll make sure to report them to you in these videos. So until then, I'll talk to you next time.